Good afternoon, fellow webinarians. My name is Professor Alan Layton. I'm Vice President, Resourcing and Development for the Queensland Academy of Arts and Sciences. And I'm pleased to be your moderator today. Today's webinar is the fifth in the series entitled Data Science in the News, focusing on COVID-19. And co-sponsored by QUT Centre for Data Science and the Queensland Academy of Arts and Sciences. Today's webinar is focused on the short and long run economic impacts of the government's policy response to COVID-19. Compared with other countries, Australia has been undeniably very successful in containing the spread of the virus. Indeed, we have, quote, very successfully flattened the curve. And indeed, flattened it at an internationally very low fatality rate of 4 deaths per million, at least so far. Going forward, as the government gradually eases lockdown restrictions, there's more and more focus on the shape of another important curve, and that is the future trajectory of the nation's economy. We're hearing about a V or a U or even an L-shaped curve as possibly being the future trajectory of our economy in the years ahead. Unfortunately, it is now almost certain that Australia, for the first time in 30 years since 1990, will probably enter into a recession this year. This raises some incredibly important questions. If we do enter into a recession, how deep will the contraction be? And how long will it last? And what impact will that have on the nation's unemployment rate? What level will it peak at? And how long will it take to revert back to pre-COVID-19 levels? In the United States, in that country, the unemployment rate has already spiked up to 15%, the highest level seen in that country in almost a century, since the 1930s Great Depression. And what of Australia's macroeconomic policy settings? Are they appropriate to achieve the most highly desirable V-shaped recovery? And even if they are successful, what will be their long-run impacts on the economy and the nation? And what of Australia's trade situation? Has the global response to COVID-19 permanently affected the volume, trajectory, and pattern of Australia's international trade? And whilst Australia is inextricably entwined in the global economy, at the end of the day, we all live locally. So what has been and what are likely to continue to be the impacts on the local regional economy? Something that I'm sure will be of great interest to the Queensland-based participants in today's webinar. To shed light on these issues, we have today a very fine panel of 4 highly qualified economists, and I'd like to introduce them to you now. First, we have Ms. Danielle Wood. Danielle is Budget Policy Program Director at the Grattan Institute. Welcome, Danielle. We also have Professor Tony Macon. Tony is Professor of Economics within Griffith University's Business School. Welcome, Tony. Our third panelist today is Professor Pascalis Raimondos. Pascalis is head of school of QUT's School of Economics and Finance. Welcome, Pascalis. Finally, we have Mr. Gene Tunney. Gene is director of the well-respected economic consulting firm, Adept Economics. Welcome, Gene. As we listen to our four panelists today, if you have a question, please use the Q&A function at the bottom of your Zoom screen. I will endeavour to pose as many questions as I can, time permitting, to our panelists. However, we'll leave all questions till after all four panelists have presented their initial remarks. So let's begin, and we'll start with Danielle Wood. The title of Danielle's presentation today is Managing the Transition, Fiscal Policy in the Recovery Phase. Thanks, Danielle.
Thank you. Thanks very much for that introduction, Alan, and hello, everyone. So given it's a data science presentation, I couldn't resist putting up a few charts, so I will try and share my screen now, fingers crossed. Confirming, can everyone see, or can someone on the panel let me know they can see my screen? Fantastic. Okay, let's kick off. So I thought I'd say a few words about the nature of the economic shock and then what that means for the fiscal policy response. As economists, this has been quite an unusual one because rather than sort of a demand or supply side shock coming via market mechanisms, what we've really seen as by government decree, big sections of the economy essentially closed overnight, a wall being put in place between demand and supply, so the normal value enhancing transactions can't occur. And then we're also seeing a sort of second round demand side shock as people lose income, as they lose their jobs, as they feel uncertain, they stop spending. And so we see the kind of the waves of this reverberating out to all parts of the economy. It is also highly unusual in the speed at which the shock has hit. If anyone looked at the labour force stats that came out last week, we lost 600,000 jobs in 1 month. I think the previous monthly record was something around 75,000. So it's absolutely extraordinary how much this has changed our economy in such a short time. At Grattan, we've put out something called an econ tracker, and if you can Google it, you can have a look. Essentially, it's just a whole series of indicators about the health of the economy, economic activity, and we think it's really important, given this speed, that we have a lot of real-time data about how things are faring, so we update this every day. We know that ABS stats, as good as they are, we have to wait a month for the labour force and a quarter for the national accounts figures. So it's important to have more up-to-date information. These are just two of the stats that we have there, business confidence and consumer confidence, and as you can really get a sense of that speed. Both of them dropped to historical lows when everything was shut down on March 23rd, essentially overnight. So to the fiscal response, Australia's responded pretty aggressively, both with fiscal and monetary policy. This chart was prepared a few weeks ago, so things may have moved around a little bit, but I think the key point still remains. We have one of the largest responses in terms of direct fiscal measures in the developed world. The government's committed to $194 billion of additional spending, almost all of it this year, so close to 10% of GDP. And what they've been really trying to achieve with that, particularly the two big programs, the JobKeeper and JobSeeker, it's been about trying to keep businesses and households alive during the shutdown period. So we've heard a lot about the bridge. The idea being is we want to emerge on the other side of this crisis with Australia's productive capacity intact. We don't want to lose large swathes of businesses. And of course, we want to support households so that they can continue to pay their bills. So if we look at the question of household income support, this gives you a sense of what the two packages are doing. Interestingly, because they are both flat payments, they do a lot better at replacing income for people that had lower incomes pre-crisis. And in fact, as you see there, particularly for the JobKeeper payment, a lot of low-income households are actually experiencing an increase in their incomes during this crisis because that flat payment is higher than what they were earning before. job seeker is less generous, so obviously that's less often the case. And as you get higher up the income distribution, you can see those packages are less effective in terms of replacing income. I think it's pretty clear to everyone that these packages are far from perfect in their design, and obviously this is kind of an unusual result. That said, the government decided to prioritise speed, getting money out the door quickly over design perfection, and I think that was the right answer given the speed at which this crisis came on. So what happens from here? So as Alan said, you know, there's a lot of debate about whether this is V or U or what it looks like. I think you have to be a pretty big optimist to think this looks like a V. We've got a whole lot of questions on the health side still about how quickly we can open up without a second wave. But even when you put those to one side, you know, we're in the middle of a globally synchronized deep recession that clearly has implications for a trading nation like Australia. I'm pretty sure consumer and business confidence is going to be subdued for some time. We have a lot of debt overhang. Businesses and households have taken out deferred payments on their loans. They've deferred rent in some cases. So that's going to soften demand on the other side of this. We've taken a big hit to our population, and we know that Australia's growth rate has been propped up by pretty high population growth, particularly in the last decade. Our population this year will probably go backwards because of the loss of temporary migrants. That obviously hits your headline demand and growth as well. So we have a whole lot of economic challenges, I think it's fair to say. And what we see is that all of the major supports that the government's put in place, not just in terms of the fiscal measures, but also in terms of a lot of the regulatory supports, you know, working with banks around loan holidays, some of the rental agreements that exist, particularly for commercial tenants, all of them are going to be gone by the end of October. And why that concerns me, if we just look at the fiscal measures, we're going to go from a world where the government is putting about $120 billion of extra support into the economy in the September quarter of this year. That's about 25% of GDP. You know, that is absolutely extraordinary intervention. But then it essentially just turns off. So by the end of October, that is all gone. And I think that, you know, poses a real risk to household business incomes and to the broader economy. So we're certainly advocating for, you know, there's ways in which you can transition off those schemes that takes back support from businesses that no longer needs it, but perhaps keeps it in place for some of those that do. And I think we should be talking about the need for fiscal stimulus late in the year and early next year when that government support disappears. Now I'm going over time, so I'll be very quick here. Can we afford it? My view is yes, we can. This is an extraordinary economic shock. The government has done the right thing by intervening strongly. Yes, it means we will come out with substantially more debt than we came in. You know, there's various estimates floating around, but probably somewhere in the vicinity of 50% of GDP gross debt, $1 trillion. It's a big number, still very low by international country standards. Interest rates are low. And in the medium term, yes, that means we will obviously need to consolidate the budget position. But as you can see, you can get debt on a fairly manageable trajectory over the medium term. So I think government should focus on supporting the economy now, and then we can talk about how we pay for it in the next few years. Thanks very much.
Okay, thank you very much, Danielle. I guess it will just be so important that the government gets it right as far as transitioning away from the current policy settings. So thank you very much. We now move to Tony Macon. Tony's talk today is entitled COVID-19, the Macroeconomic Response, Recovery and Repercussions. Tony, over to you.
Hello, everybody. Let me start by thanking the organisers, Alan, Joyce, the QUT Centre and the Queensland Academy for staging this event on a topic of utmost importance to all of us. Australia will never be quite the same as a result of this crisis. What I'll briefly discuss, and there will be a little bit of overlap with Danielle's excellent preceding presentation. I'll try and avoid that overlap, but I will discuss the features of the Australian response in an international context, why this crisis is not a textbook macroeconomic crisis. We've, as I've said, seen nothing like it previously. Then say something about the merits of the macroeconomic response to date, and then just briefly address what lies ahead in terms of reforms that are necessary. I'm sure some of those issues will come up in question time, so I won't spend too much time on that last aspect. So globally, the impact of this crisis has been devastating around the world, regardless of development levels. Millions of people in our region will fall below the poverty line as a consequence of this. The world is now in recession, much worse than the global financial crisis. And it remains to be seen just how many quarters it will take before recovery begins. And of course, that will be patchy and will be regional. Australia and New Zealand have been hit much harder than elsewhere in our region due to the large services sectors in our economies, and relatedly our heavy dependence on tourism and on education, particularly tertiary education. So Treasury is forecasting a 10% contraction this June quarter, 10% unemployment, although likely to be considerably higher, as we've learned, because of the distortion due to the JobKeeper program. So like governments abroad, the Australian and state governments have tossed out the normal rule book. Central banks have massively increased liquidity, and remember that interest rates were already at historical lows, and we've now seen measures of quantitative easing or monetising debt around the world. So there's been two basic approaches to dealing with the unemployment consequences of this crisis. First, there's been income transfers provided to households and firms, and secondly, there's been wage subsidies. The United States has pumped some $3 trillion in budgetary assistance to households and firms as direct transfers. Other countries, New Zealand, UK, Singapore, European countries have tended to favour wage subsidies. In Australia's case, we chose both income support and wage subsidies. So it's been exceedingly generous, amongst the highest in the world. It remains for analysis to sort of look at forensically just how successful that program has been. Of course, there's a Treasury review of JobKeeper coming up end of June, so we'll eagerly await to see what they're going to do with fine-tuning of that program. So as I said, it's not a textbook crisis. How do we analyse this crisis using standard tools of macroeconomics? Well, the answer is we cannot. There's no university textbook analysis of economic-wide shocks of this kind. So it's most akin to a government command and control of a warlike economy, an economy at war, in this case against a foreign invader, invisible. Usually economists interpret macroeconomic shocks with respect to the demand side or the supply side, and they always stem from private sector sources. However, this has been a simultaneous aggregate demand, aggregate supply side shock, which is caused by mandated government action. It's affected both the tradable sectors in the economy and the non-tradable sectors, probably more so the non-tradable sectors, entertainment and so on. So we've seen both aggregate supply and aggregate demand collapse severely, and the consequence has been compounded by the loss of income feeding back in a feedback way to spending. And that will be constrained given the extremely high uncertainty which is likely for some time. So the monetary response and the fiscal response were necessary to support both the aggregate supply and aggregate demand side. On the fiscal side, I do take exception to the frequent use of the word stimulus. It's really Stimulus is a word that means rouses activity, but in this case, we're talking about policies that are keeping the economy on life support. So let me just say a little bit about the JobKeeper wage subsidy, which really is the centrepiece of the fiscal response. First off, we've seen nothing like this on this scale in Australia's history. And its novelty is that it's a fiscal instrument that's directed to the supply side of the economy, unlike the standard Keynesian approach, where there's attempts to stimulate the aggregate demand side of the economy. It's not an Australian innovation, I should add. It mimics schemes that are in place in New Zealand, United Kingdom, and Singapore. It's very expensive, and no doubt more will be learned about the inequities and the rorting in the scheme in due course. But as I say, it's preferable as a measure to the normal stimulus measures. So let me conclude just by saying a few words about the recovery from this abysmal crisis. What we've seen is an economic sudden stop, which has impacted the private sector predominantly, universities accepted. So it therefore follows that recovery will depend primarily on a revival of business activity. So there needs to be ways to incentivise business, principally to reduce regulations that stifle enterprise. After all, most Australians are employed by business, so making them more competitive, including through fostering international trade, not retreating to protectionism, is an obvious way forward. Thank you.
Thank you, Tony. Thank you very much for putting Australia's policy response in the international context. We'll now move to Pascalis Raimondos. Pascalis' talk today is entitled "The Aftermath of COVID-19. Are we now in a global recession?" Thanks, Pascalis.
Thanks, Alan. Thank you very much, and hello, everybody. So I'll try to share my screen and see how we go. So yes, as Alan said, I'm going to talk about global recession and global data, and especially focus on the importance of trade, of world trade. So let me start with a figure that describes the world in colors. So this is the world as we know it, and there are green everywhere. Green means that it's a high growth, positive growth. And the deeper the green, the deeper the higher the growth. And of course, there are some countries that they have a high growth. That's 2019, and everything goes well. And the pictures change immediately if we go to 2020. So basically, you see from a year, December 19, where everything was green and the economies were growing highly. In 2020, we expect everything to be in red. And deep red is actually losses more than 3% of GDP. Okay, so what is happening is, of course, that we can take a longer perspective and see these V's that the previous speakers have talked about. This is now data from the IMF. It looks from 1980 until today. And you can see the yellow line, which is the world, and the green line, which is Australia. And you can see periods where the world went down the zero line, and that is in the GFC crisis in 2008, 2009. And there is a clearly V that goes down and then goes up again. It took a couple of years to go up, but it does go up. And Australia didn't go in the negative in that period. We kept all the way above the zero line. In 2019, we have a 1.8%, around 2% growth. And then suddenly in 2020, we have a huge reduction. It's projected that it will go all the way down to minus 6.7. This is much bigger than the world reduction in the world GDP. but it's really substantial. And the V, the question is whether there's going to be a V, is whether they will go just as quickly up, or it's going to be a U, where it will take longer time to go up, or maybe even an L, as Danielle mentioned, that it will stay low at a period. Well, world trade is very important in explaining how the economy will react. And I'll show you here some data that start from 2000 until 2022 from the WTO, the World Trade Organization. Now, it's really interesting to see the beginning of the line here. This is an index, so with 2015 being the 100. So you can measure the differences as percentage changes. But since 2000, it has been an increase. Now, 2000 is important because we have the China entering the World Trade Organization, and you really have a pickup of trade. So the trend line after 2000 is very steep. This is the gray line over here. Then we have, of course, the crisis in the GFC, and we have the V again in the trade data, and it picks up a couple of years after, but in a different trend. Now, interestingly, the trend, the yellow line, the dotted yellow line here, is exactly the same with the, if I can project that line all the way before 2000, it keeps the same trajectory. So yes, the first 10 years of the 2000 were quite different. But now we went back to something that it was before 2000. Again, very positive, a quite steep trend. So the question is, what is going to happen now? The projection is either it's going to be the green recovery or the red recovery. The green projects a fall 13%. The red projects a fall of 32% in 2020. So what is it that makes it likely that this red line will happen? And of course, what it is that, and now this is real data, is not projections. And what you see in this data, in this spider kind of data, is that from the moment that the crisis hits, which is month 1, how many months it takes for the data, the data in the next month. And you see the blue line is the GFC crisis, and you can see the spiral, how it goes towards, there is a huge reduction. It goes down to 60% of what it was, and then it starts getting up again. And that takes around 11, 12 months for the trade data to react. So there is a crisis, there is a reduction, a slow reduction, and then it goes up again. Now, the yellow line is the current 2 data we have 2 months after the crisis for the world economy, and you see how much faster trade is falling. And of course, there are 2 additional things that are happening. The first one is the collapse of the global supply chains. Nobody could buy anything for intermediate goods. And of course, is as Tony was also mentioning, is the decline of the service trade, which is education, tourism, construction, haircuts, everything that has to stop immediately. So yes, we are having a much sharper decrease. The positive thing, of course, is that whatever goes down goes up also. So it can recover very fast. And the reality is that the COVID-19 did not destroy real capital as the World War II happened, for example, nor financial capital as the GFC did, where the financial sector lost its credibility. So in a way, lifting the lockdown should quickly lift the economy activity, other things equal. This is a typical thing that economists say, other things equal. And in a way, I guess we should understand that, this short-term government support that Danielle nicely presented in the beginning is exactly that purpose, that you should keep things alive until suddenly we can start, when we lift the lockdown, production can happen. And the question is, what is a short term, as Danielle was saying, but the idea is that, yes, that's not permanent things we put forward, we keep the economy alive, and then we can immediately react. However, things may not be all equal, may not be the same as it was before. And what I'm alluding here is that this globalization, this trade data were under attack before COVID-19. And the pandemic can make things worse for trade. Now here, of course, I'm referring to that flat part of the curve, if I may go back and show you, that you see here in the trade data. This is where the moment where trade wars between US and China have started. The world is becoming more me first, and then you do see in the world trade data a flattening of the curve. Now, this is the big dangers, and the big dangers is whether this behavior may change towards even more me first kind of policies. Okay, so there are some lessons that we learn in economics and that we teach at university. So basically, you know, there is no doubt that this made in Australia may get a different meaning in the future for some products. Imagine, you know, pharmaceutical products or medical products. But there is still one lesson that we should never forget, and that is the smaller you are, the bigger the gains you get from trade. So, and as both speakers mentioned, I mean, the prosperity Australia had from the 90s, and I think Alan, you mentioned it also, since the early 90s, has been built on open global markets. So it's really important for Australia to keep that policy there and not make any changes in how we treat, how important is trade for the Australian economy. I'll stop there, Alan, and we can talk more later on. Thank you, everybody, for listening.
Okay, thank you very much, Pascalis, and I think you're absolutely right. The danger is that many countries will have a totally different attitude towards international trade as a result of this crisis, and that could well be to the detriment of all. Let's now hear from our last speaker, Jean Tunney. The title of Jean's talk today is Short and Long Run Impacts of Coronavirus on Queensland's Regions. Thanks, Jean.
Thanks, everyone, and thank you for, thanks, Alan, and thanks, everyone, for joining us at this webinar. This is obviously a very important topic, and there are big policy issues that Danielle and others have raised, and I want to raise a couple that are relevant here in Queensland by the end of my remarks. Now, let's... Okay. So earlier this week on Monday, the Courier Mail had the headline, "Desperate Plea as Business Hits Crisis Point," and it was referring to the CCIQ pulse data that had come out. Hang on. Earlier in the week on the Monday. So we've seen an absolute collapse in confidence in both the Queensland and Australian economies. So that's the 12-month outlook. And the report contains some really extraordinary comments from businesses across Queensland. And I think they illustrate that this is a crisis that is affecting all of the regional economies, but it is affecting some more than others. So there are big hits across Queensland, but then we're seeing very profound impacts in economies that are highly dependent upon the most affected sectors, particularly hospitality and tourism. So we'll get into that a bit later and what that might mean for policy. So in the CCIQ report, we see comments such as international and domestic tourism is currently dead and will stay that way for months. That's from a business owner on the Gold Coast. In Rockhampton, we have a business owner saying that currently confidence appears to be at an all-time low. Customers are holding on to cash and not wanting to pay bills. And a business in Brisbane the owner says, allowing the economy to hibernate for too long will take decades to recover. No business, large or small, can survive to maintain the current situation for an extended period of time. No government will have deep enough pockets to fund this. And I think that's an important thing to think about, because Pascalis was mentioning that if you're optimistic, you could be saying that because we haven't damaged physical capital and the damage to, the loss of financial capital may not be as great as in the financial crisis, although let's wait and see what happens. You could think that there could be a rapid recovery. But the longer this goes on and the more damage there is done to the balance sheets of businesses, and the more likely they'll fail and they won't be there to rehire workers. And that is a grave concern, because we're seeing some very profound impacts on businesses. And others have mentioned the big drops in employment we've seen. We saw nearly 600,000 jobs lost in the Australian economy, and 130,000 in Queensland. 3/5 of those roughly were part-time. So that's because of that's because it's disproportionately affecting hospitality and that sector in particular. We've seen, big loss of jobs on the Gold Coast, as you expect. These are the ABS data I'm showing now. There's a lot of sampling error in them, so that some of the numbers look funny, but I just wanted to put it up there to illustrate that we are seeing substantial job losses, thousands of job losses in the regions across Queensland, over 20,000 or around 23,000 on the Gold Coast. Unemployment rates spiking up generally. The Queensland unemployment rate went up to 6.8% from, I think it was 5.7%, but that's hiding the fact that there were a lot of people who effectively, they dropped out of the labour market, because you have to be actively looking for work to register as unemployed in the ABS labour force survey, and this isn't really a good time to be looking for work, quite clearly. And you can do some simple arithmetical calculations which would suggest that the real unemployment rate even now is around 10% for Australia and over 10.5% for Queensland. And then if you look at the underemployed, you're getting much higher rates of underutilisation as well, and that they were reported with the labour force data. What we're seeing is that the impact is going to be, well, it is much greater, and it's going to be concentrated, it's going to be excessive in those regions which are highly dependent on tourism. And we see that the extent to which regions are dependent on tourism differs starkly across Queensland, with Whit Sundays, tropical North Queensland. So that's the area north of Townsville, so far North Queensland, Sunshine Coast, Gold Coast, Fraser Coast, very dependent upon tourism. And those are regions that we expect will be very hard, profoundly damaged by this crisis, and that it could extend for a long, much longer than we expect if business owners shut down. And I mean, we know that that is occurring at the moment. Some of the best estimates I've seen are from a colleague of mine, Pete Faulkner from Conus Consulting. He's based in far north Queensland, and Pete's on the webinar. He's one of the attendees. So hopefully I can get Pete into the discussion. And what Pete's done is he's looked at the broad range of data that are available from the ABS, and also the single touch payroll numbers that the ABS is publishing, as well as their official labour force data. And he's formulated some forecasts of, what could happen with unemployment over the rest of the year. And you can see on this table here, which Pete's put on his blog, that from time to time he updates it. I'm sure we can make this available. We see that a region such as Douglas, so Port Douglas, possibly up to 22% unemployment rate by June. The state unemployment rate could get up to 8.6%, Australia 8.7% on Pete's forecast. But again, remember, it'd be much higher were it not for the fact that people were dropping out of the workforce. So I'd encourage people to have a look at Pete's numbers there. So we'll be able to make those available. And what we need to think about now is just how important it is to open that border as soon as we can to allow tourism back into Queensland. I know this is a very challenging issue for the government because of the concerns over public health, and New South Wales hasn't done as well as Queensland has on controlling coronavirus and stopping the spread of community transmission. But what we're seeing is that a lot of these businesses in the regions and in North Queensland, Cairns, Port Douglas and Gold Coast, they're almost at breaking point. Many businesses will have shut down and won't be opening up again. We need to think about that border, and if we can get it open before the school holidays, this is coming up to a critical period because these businesses rely so much upon that business coming in over that school holiday period. So hopefully we'll be able to open up that border. One of the points that the Prime Minister has been making, which does provide some glimmer of hope, is that Australia is a net importer of tourism services, which is to say that we spend more money overseas, so Australian residents spend more money overseas than foreign residents spend coming into Australia. And there's a trade balance deficit in tourism services of about 19 billion on the last figures I saw. So there's a potential that if Australians don't go to Kuta Beach and instead go to, or say, Mission Beach or they go to Port Douglas, then we, that will help our tourism sector, and that will be an important part of the recovery. Finally, this is such a great challenge for government, and this dwarfs the problems that I saw firsthand when I was in the Treasury during the financial crisis. This is just really incredible. I worked with Steve Kennedy, who's the new Treasury Secretary and is the architect of JobKeeper, apparently. And I remember Stephen was one of Rudd's economic advisors at the time, so he's had experience in this. And I would echo Danielle's in a point that there are flaws with the design of it, but it probably, it has helped a lot, and you do have to prioritise acting fast in this situation. And Tony's point about this being unprecedented, we don't really know how this will all play out. We've run a big experiment with the economy and shutting it down, and we haven't done this before, or we haven't done it at a period where we have reliable data, and so we'll learn a lot from this experience. And the final point I want to make is why I put this coal price chart up, is that governments are going to be relatively constrained in what they can do because of a lot of the actions they've taken already. JobKeeper was absolutely extraordinary. I think they're going to be pushing the capacity of the AOFM, the Australian Office of Financial Management, to borrow money fast enough to pay for everything. So it's certainly costing a lot, and they will need to think about just how much support, how long they can extend it for beyond when it runs out in September. I think it'll be very challenging to keep it going much longer. And the coal price is there for Queensland, which is one of the major influences on our budget. And our state budget's expected to be state budget deficit's expected to be about $8 billion this financial year, $8 billion next financial year. The government is taking steps, looking at investing in Virgin and doing a whole bunch of things, infrastructure projects, financial assistance to tourism operators and other businesses, but it too will feel constrained. So the critical thing is getting the economy moving again as quickly as possible. Okay, thanks for that.
Okay, thank you, Jean. I just want to remind participants that if they have any questions, could you use the Q&A function at the bottom of your screen, and I'll pose them to the panel. I'll just, while folk are considering their questions, I'll just ask a few myself. Danielle, you didn't go too much into detail about the specifics of what the future fiscal policy may be. I was wondering, in terms of spending on infrastructure, whether we should transition into the government picking some infrastructure projects to fund during this time to kickstart real economic activity again. Do you have any comment?
Look, I think, when we start talking about fiscal stimulus, infrastructure should be on the list, but, the key to stimulus is you want it to be targeted, temporary and timely. So what you want is projects that you can, roll out really quickly and also turn off if it looks like economic activity is coming back. So good idea. Construction sector always gets hit in a downturn, but I'd like to see smaller projects that yield a good social return. So things like social housing, road maintenance, maintaining schools, building new schools in the case of Victoria where we've got a backlog of need. Those sort of things are all great for fiscal stimulus. What I wouldn't want to see is kind of mega projects. We've heard a lot about high-speed rail again down the East Coast, the perennial that keeps coming back. So projects that don't necessarily have a good benefit cost ratio rolled out in the name of nation building, I think that would be a mistake. If they're good projects, do them, but don't do it under cover of the need for stimulus, because that's not really what proper stimulus looks like.
Thanks, Danielle. Just a quick one, Jean, because we want to get to some of our other participants, but Danielle just mentioned avoiding large-scale projects. Do you have any comment on that? So in terms of the Queensland situation with talk of a new Bradfield scheme? Just a quick one, Jean.
Yes. I echo what Danielle has said, and I think Queensland government set up a pretty good process at with the Building Queensland with their detailed business case assessments, and so I would say that let's stick with that and let's not commit to big projects that could be white elephants. Let's make sure things stack up.
Thanks, Jean. Pascalis, I just have a quick one for you also. Do you think there's a real danger as a result of this pandemic that nations will really, as you said, become more interested in their own selves and renationalize supply chains? Is that a danger, or do you think that is actually a sensible response to the reality of COVID-19?
I don't think that this crisis has shown that there is a danger. I mean, this pandemic crisis means that it closes down our own factories as well. So even if we had our supply chains within Australia, still we would have been locked down. I agree that one has to be risk management, the supply chain. So we shouldn't have everything in one geography, in one place, in China, for example, but we should spread it around the world, because it could be a climate shock or other kind of shocks or political shocks. So the lesson from here is that supply chain should be like a portfolio, that you have them around the world and you take from where it's best. I don't think that saying that suddenly we should have everything in Australia is the lesson from this crisis that we have. If anything, I mean, we have to cooperate to solve the pandemic problem in the medical respect also. So collaboration is even more important in the cases of crisis. It's not less important. So I wouldn't say that, no.
Okay, thanks, Pascalis. And Tony, just back to you. I think someone, it may have been you or it may have been Danielle, but someone mentioned the possibility we might soon be heading towards $1 trillion in public debt. Is this a concern for us, do you think, or should it not be, in your opinion?
Yes, in my opinion, I think it's a grave concern. I mean, people say Australia doesn't have a high level of debt relative to other countries, but Australia's debt is different for two reasons. Firstly, we borrow about 2/3 or more from overseas, unlike other countries. And secondly, the federal government's balance sheet is in a state of disrepair because most of what the federal government spends on, and in the latest bout of fiscal stimulus we've seen, or fiscal support, we've seen the income support, which is a feature of the federal budget. So the federal government is not in the business of acquiring assets, in which case its liabilities run up and it leads to a negative net worth. And that's been the situation for the years since the global financial crisis. So there's huge risks there. I think the credit rating was teetering before this happened. I think there's a strong chance that'll go, which will have implications for interest rates. But globally, I mean, we haven't seen anything like this since the Second World War, and people say, well, we got through that. But we saw that it took decades to get debt down to sustainable levels or comfortable levels, and that was partly through high inflation. So there's a risk of inflation going forward with all of this monetisation of the debt that's occurring here at UK, US. Monetising the debt's going to mean an enormous boost in money supplies, and history tells us that it may not happen straight away, but down the track you're going to see bouts of high inflation. Alternatively, and as pessimistically, I'd have to say, we could see the world turn more like the Japanese economy, which is burdened by the highest level of public debt in the world at over 250% of its GDP. And we've seen that the Japanese economy, under the burden of that debt for a couple of decades, has not performed well. And the reason is that when you've got a huge debt to roll over, that you have to keep absorbing saving, which could otherwise be directed to more productive uses, and that would be private investment. So private investment is the driver of growth. It's the driver of productivity, and that's what we've got to see revive going forward.
Okay, thanks, Tony. Here's a question for any of you or all of you. It's one from me. It goes like this: in the 1991 recession, the cumulative contraction in real GDP was only 1.1%. That was the cumulative contraction. But due to the very lethargic recovery, unemployment still peaked at 11%. So given what we're seeing so far, well, it looks like we're looking like a significantly deeper contraction than just 1.1%. What is the best we can hope for this time round? And what might be the worst? Anyone?
Well, I think there will be a spring back that's quicker than previous classic recessions, and JobKeeper is a reason for that. Keeping people in employment makes a lot more sense than governments going out and spending in other areas where you don't necessarily have the same transfer of skills for workers. And I instanced the GFC response, which I've been critical of. You're building school halls when people in the banking sector are unemployed. In this case, building infrastructure when you've got hairdressers unemployed. It's not going to work that smoothly in the employment market. So JobKeeper, I think, has been a very appropriate way to respond to the crisis. It keeps people in the workplace. It's expensive, but it's far better than the classic Keynesian aggregate demand response of ramping up government spending in other areas.
Okay, Tony, anyone else? Otherwise, I want to follow up what you just mentioned. You were talking about JobKeeper, and Danielle also mentioned JobKeeper as well, and you both, I think, speak about it favourably. Danielle, it doesn't seem logical to me that the payment will simply go to zero, from $1,500 to zero in 26 weeks. Some tapering must occur. There's been no announcement yet as to how it might be rejigged, but what would be your thoughts on treating, adjusting the JobKeeper payment going forward?
So I would like to see a reassessment of eligibility, essentially. So at some point in the coming months, we know that as part of the scheme, businesses had to submit their revenue in March and show that it was down compared to a previous period. If they resubmit their revenue, if it looks like it's bounced back, sufficiently close to more of a normal level, I think they should come off the scheme, and that's even potentially early in some cases. On the other hand, if their revenues are still substantially down, and I'm particularly concerned about sectors where social distancing restrictions may still be impacting their viability. So I'm thinking things like restaurants, bars, things where I actually expect we're going to have some restrictions for many months to come, and that's going to affect their ability to offer to come back and be profitable. They could stay on for longer, so a potential extension of the time they're on the scheme. You could play around with the level of support. It gets complicated, obviously, from the workers' perspective, because if it gets below the level of social security, they might be better off dropping out of the workforce, and there's all sorts of complications there. But at the very least, a reassessment of business eligibility, I think, is a good way to go.
One question that some folk might want to answer is the issue of a second outbreak, and what might the government response be if there is such a second outbreak as a result of easing the lockdown restrictions. Does anyone want to comment on that?
I'll comment, Alan. I mean, obviously it would be bad, so we'd have to reimpose some restrictions. I mean, we've only just started loosening them, so we'll need to. I mean, we'll have to see what happens as we gradually loosen. I think they're taking the right approach, which is to incrementally loosen, and all going well, we won't have that second wave, and a lot depends on the contact tracing and the COVID safe app. So look, maybe we don't have it, but yeah, I'd hate to think about it. I think it'd be terrible. This is going to be a big issue with the US, and this is why the global economic recovery might not be, why it might be, it won't be a V-shaped. It could be an L-shaped, or a Nike swoosh or whatever. It could take some time because the US, the policy settings in the US look terrible. They don't have any national leadership on coronavirus, and they're at risk of a second wave. They're opening up, and the cases are only just starting to decline. It is, it's really scary.
Okay, look, folks, there's many questions that we just don't have time for. So apologies to participants because we're already at the hour. So apologies to those participants who've asked questions, but we do really need to wrap things up. I just wanted to remind people that as well as this webinar being recorded, any unasked questions, the panelists will look at them, and if they feel they can make some response to those questions, they'll make an answer to those questions, and those unasked questions and answers will also be posted onto the websites of both the Centre for Data Science at QUT and also the Queensland Academy of Arts and Sciences website. So it is time to wrap up. First of all, some thank yous. I'd like to thank our panelists, of course. Thank you, Danielle. Thank you, Tony. Thank you, Pascalis, and thank you, Jean. Also, special thanks to Kerry Mengerson and her team at the Centre for Data Science, especially Joyce Wang, working behind the scenes to ensure a smooth running of all of these webinars, including today. And of course, a thank you to all of the other participants today for sharing your time with us. We hope that we've been able to shed some light on those questions, those issues that I raised at the very beginning of the webinar in the introduction. So thank you to everyone for participating. Just before I go, a quick advertisement. The sixth webinar in this series will be in 1 fortnight on the 5th of June, and it's focused on life, quote, life post-COVID-19 and developing strategies aimed at escaping from COVID. So that sounds very interesting and uplifting. Till then, I hope you all enjoy getting out and about a little more. Stay well, stay safe, and do stay tuned. Thank you very much.